quick video going over EAC. I've just seen I made a mistake there. EAC, question 19. I think it's chapter 10 in the e-text, so this is week 6 material. So this is all the same logic as capital budgeting. The reason why we take this different step to look at equivalent annual cost is when we've got two projects here, which as we can see, if I highlight those two, have different lifespans. So if they're two different lifespans, it's a bit like measuring apples and oranges. So we can't just do our cash flow like we do in our capital budgeting. So we need to look at the annual equivalent cost, EAC. So this is just an extract out of the e-text. It just says, this is relating to another question, but I thought it summed it up pretty well. We need to somehow work out a cost per year for the two alternatives. To do this, we ask what amount paid each year of the life of the machine has the same PV of costs. The amount is called EAC. So that's what we're trying to do. So it's very similar to those cash flow, capital budgeting things we do. But here we're looking at the annual equivalent cost. Anyway, let's jump into this question. I've created a little table here to help us work through it all, and we can plug it all in. So let's have a read of the question. So you are evaluating two different silicon wafer milling machines. The Techron 1, so this is our yellow section here, costs $245K, which I put in here, has a 3-year life, and pre-tax operating of $63K. Number 2 over here in our green has a cost of $420, 5-year life, and pre-tax operating costs of $35K a year. For both milling machines, they use straight line depreciation with a zero balance. So our depreciation, we go 245, 123 over our 3-year life. So that's our depreciation amount. Let's do our depreciation amount of the other one, 420 divided by 5. So that's our annual depreciation amount. And then it's saying both projects have a salvage value of $40,000, which I've included in here. Tax rate is 30% down here, and discount rate is 10%. So step 1, what we've got to do, well, first off, I've already gone ahead and I have created my data. So this is my data set here. And then what we're going to do is we're going to look at the cash impact. Now, remember, we're doing this with our capital budgeting big cash flows. So we need to think, what is our cash impact? So when we've got a cost, we're buying something, it's money out the door, right? So we're going to go negative 245. Okay, and the same here is negative 420 for our other one. Okay, because that's money going out the door, so it's a negative. The next thing we need to consider is our costs. So we've got 63K of costs going out the door each year. Now remember, with those costs, we get that tax deduction. So what we're going to do here is we're going to reduce the tax. So we're going to go negative 63 because that's money going out the door. And then we want to times it by 0.7. So otherwise we could do it times by 1 minus our tax rate down here if we want to be technically correct. And we can get our amount there. Okay, so that is the next net cash impact for that cost. So that cost, obviously we've got money going out of that 63K, but as it's a tax deduction, we also get that tax benefit of 30%. So that's why we're deducting it. So let's do the other side. 35. It's a negative. Remember, it's money going out the door. I always forget to do my negatives. Times by 0.7. So, times by, not divide, which is $24,050. Okay. So what I'm going to do is in our annuals, what I might do is just put that all in italics to help us with our memory for what we're doing. You'll see why I do it in a minute. Now, depreciation. Now, depreciation itself isn't a cash impact, is it? All it does is write down the value of the cost of an asset in the books, right? So it just brings down the value. But what impact does it have as a cash impact? The depreciation. So if we're writing something off, that means we get a tax deduction, that means tax back. So it's going to be a positive, and our tax rate's 30%. So we just go that by 30%. Okay, we're just thinking about our cash impacts here. Okay. Then what I've got here is my net annual position. So all I'm going to go is the cost plus the depreciation. I can copy that over there. Oh, I don't want that yellow though. Let's just do it this way. Plus 25,000. So our net annual cash flow for option 1 is negative 19,600. Cash flow 2, it's net positive 700. Okay, and then the last thing we need to think about is what is our cash impact of the salvage value. Now, salvage value means money. If we are selling at the end of its life, how much money are we going to get? So money we're going to get is money coming in the door, right? So if we've got money coming in the door, we also have to pay tax on that, don't we? So tax is paid, tax is money going out the door. So what we want to do is we want to reduce the tax of that. So we've got 40,000 and it's a positive, right? Times by 0.7, right? Because we want to reduce the tax. So we're looking at that cash impact. Okay, so that's the same, and then it's exactly the same, 40,000 times by 0.7. When it comes, just like a little note, when it does come to your capital budgeting cash flow, you probably will, if I had my cash flow here, you probably go salvage value and then tax impact of salvage value, and you'd probably list it out separately like this. Negative 0.3, if I got that right. So the net sum is 28,000, as you can see here, and that's what we're including. But you might split it out and actually show the details so we can actually see, okay, what's happening here. We've got money coming in the door, money going out the door for tax. Okay, just showing you how it all marries up. Okay, so that's pretty much step 1 done. We've looked at our cash impact. The second step is we've now got to calculate the PV, and PV is at the point in which we purchase it. So what we need to do is, as I said, calculate the PV. So I'm going to bold the numbers we're going to have to calculate the PV for. Now, why am I not selecting these 2 numbers is because we've already done our net annual position here, okay? And we're bringing it back to the PV date at this point in time. So all I need to do is use these figures because we don't need to adjust or bring it down because it is the value that it is at that point in time. You can see I've already got my total PV here, so that's going to accumulate when I input my figures here. Okay, so this here is a little bit more complex because we do have that annual cash flow. So we need to calculate the PV of our annual cash flow. And we can use our financial calculator to do that using the cash flow function. Now, what I've done for you here is written down what your cash flow steps are for the first option. I haven't done it for the second option because it's the same. All you're doing is 0 enter, 700 enter, 700 enter up till you get 5 periods. And then you just go 10 for the interest rate because that's our discount rate over here. Second cash down arrow, so you should get the PV, and then we go comp. So once we do that, I'll be able to get my present value of those cash flows. Now, remember, if it's a negative here, it's going to be a negative over here. So that's 48,742.29. We've got there. And for our $700 one, actually, it's going to be a positive. Remember, that's a positive. It's going to be a positive of 2653.58. Okay, so that's basically looking at, okay, this is our projected cash flow and what's the present value of that cash flow over the life of the machine as at the date we purchase it. Okay, then we've got to do our final PV calculation. Now this one is super simple. All we go is 28,000 divided by 1.1 to the power of 3, because we have 3 years there. Okay, and then over here, only difference is that divided by 1.1 to the power of 5 years, because that's the life. And then now I've done my Excel formula, which is wonderful, and it's calculated it for me. So this is the total PV of both projects. Now, just looking at those PVs alone doesn't really explain if which project's the better option, right? Because we've got one that's 3 years and one that's 5 years. So what we need to do is we need to figure out what's the equivalent annual cost. And how we do that is by using an annuity factor to then use that factor to divide the PV by the annuity factor. So I'll explain. What I've done here is I've pre-done all the work for us. Thank you. So I've got machine 1, machine 2. These are the formulas in order to get our annuity factor. So it's 1 minus 1 over 10. So 10 is our discount rate, to the power of 3, which is the number of years we have, divided by 0.10. So that's our 10%. Okay, so we've been given our two annuity factors over here. So all I need to do is that divide by our annuity factor for machine 1. And then this one here, divide our annuity factor by machine 2 here. Oh, why didn't you like that? What have I done? There we go. Oh, hang on. What have I done? I did a minus divide. Okay, so I've done that, and now I've got 2 equivalent annual costs, which is great. So now that they're both in their annual equivalent cost, I can now compare them, right? Because they're just looking at equivalent, like an annual cost. So it's saying which project do we prefer? They're both going to cost us each year, but we want to take the cheapest option, which is option 2. Okay, that's the question done and complete. Now I know I am using Excel for this just because it is very simple for me to visually explain, but hopefully you can see how I am using the financial calculator here. Some formulas you need to know here. This PV calculation here is very stock standard. We've been doing that since the get-go in this unit. So you will need to understand the steps you need to take, but if you understand those big capital budgeting cash flows, this is exactly the same, but all we're doing differently is this very last step. So all we're adding on is this annuity factor here, and making sure that we're dividing that total PV by that annuity factor. So all it's trying to do is give us data where we can compare 2 projects and their cash flows and figure out which one's best. Hopefully that helps. Thank you.